Welcome back, everybody, to We Are TPM with myself, Kyle Teixeiras, sitting next to this guy, John Teixeiras. Once again, we are back this week to discuss expected returns. If you guys have any questions on this or your expectations or something like that, give us a call or, go to our website. Maybe I should start saying that. 817-818-9039. Shoot us an email at showmethemoney@weartpm.com or go to weartpm.com. Let's get into it. In real estate or property management or investing, do you expect returns? What kind of returns are we talking about here?
Oh, returns.
Do you let tenants return?
Returns.
Do you get to buy? You could buy real estate and bring the receipt back and return it, right?
Yep.
Yeah. You just go to the title company, tell them you bought this house 3 months ago, and I want a refund.
It's usually a 90-day guarantee.
Yeah, 90-day guarantee.
And you take them all to Kohl's also with the original packaging.
Original packaging?
Yeah.
Okay.
Yep.
Yeah, does someone pick it up from you if it's worth enough?
You can.
Yeah.
Yep. Bill Gates will come get it from you.
Come get it from you. And his private jet might land right next to you.
Yep.
All right. No, we're talking about expecting returns in the rental market, in the investment market, really just in the real estate market. Like, what kind of returns do you expect? It's a common question. What can I expect from this? And really what we want to talk about today is how expected returns and projected returns can vary and what they vary based on, right?
Yeah, we've talked about this subject several times lately because people are leaving and fleeing the market, right? Because of market conditions. And that's really what we need to talk about today. And let's keep in mind that your expected returns is going to be different depending on the instrument, right? Meaning what kind of investment and how did you put your capital into that investment, right? What did you expect when you invested in that asset? What kind of asset is it? Is it a large apartment complex? Is it a small house, right? What neighborhood is it in? What part of town is it in? If you're going to buy something in Highland Park, you have a different expected return than you do if you buy something in Alvarado, right?
Yeah.
So what is it,
not.
What were your initial expectations, and then what's happening to them now?
Yeah, oh yeah. If you want to get into the whole what you expected at the beginning versus analyzing that later on, maybe use the same. That's a starting point. Use the same things you analyzed it when you acquired it as when you're operating it. Like, have different expectations 2 years later.
I wish people would.
Yeah,
people usually purchase these things with a bigger picture in mind, right? And with the loftier goals of appreciating their appreciation and long-term investments and having a legacy business and legacy investment. And that's how they start. And then things go bad and they get into the weeds of these kinds of numbers that we're about to talk about, and then they they overthink that one little short-sighted point.
Well, so the expected returns should adapt with the market, right? And what do we mean by that? I'll take it from a high level because I was from an investment analysis standpoint, investors, whether you're investing in multifamily or partnership deals, or really when it comes to syndicating funds together, or really just it's targeting properties, a big one's cash on cash, right? Everybody loves to talk about cash flow, appreciation, all those things, which can vary, but cash on cash is a more simple metric that lets you compare investments kind of how you would compare any other investment, where it's how much cash do you earn on your cash, right? So if I put in $100,000 and I get $10,000 a year off that $100,000, cash on cash returns 10%. That's a 10% return.
Yep.
That's to put it simply. So this is where it brings all the numbers of a deal and turns it into bring it back to you. All right, well, this is maybe $1 million deal with this cash flow and I'm getting 20% of it, and there's my waterfall or whatever. That can get all really complex. But when you bring it all back, it's okay, if I invest $100 or $100,000 here, I can expect 10% annually back in cash, right? That's the expectation. Now,
what if you don't do that this year?
Huh?
What if you don't do that this year? Are you freaking out?
Well, once it's operating, that's a different story. But how does it vary based on the market?
Well, that's my point. What if last year you got 20% and this year you get 5%? What's that average out to?
On the 2-year horizon, what are you saying? If you got 12% and 2%?
Well, I'm just saying that people freak out about the 5% that I'm getting now. I wanted to get 10, I'm only getting 5, and they forget that they got 20 last year or 15 2 years before that or whatever.
So then I look at it and I'm like, well, you got a 12.5% cash on cash return over 2 years in a market that isn't expecting 12.5%. So, like, where does it vary? We have came from investors sometimes struggle to keep up with the market changes as far as the expectations go. Not always, but like let's use a baseline here, 8%, right? 8% cash on cash return. How would a 8% cash on cash return have sounded back in 2021 on like an investment deal? It was on the low end.
Yeah.
It was on the low end.
Yeah.
I have people begging me today to find them 8% cash on cash return today. So that let's use that analogy of what changed, right? Well, and why? 8 to 12% was pretty much the base back when, and let's just keep it to the year, like 2021, 2022. Well, that was because interest rates were like 3%, and the interest rates play a big part on the debt service on a lot of these deals, so they go hand in hand.
And revenues were going up.
Yeah, and revenues were going up. I mean, there was cash flow in a lot of these deals because of what you could get them for versus what they'll make.
And inflation really hadn't hit us yet. It had started, but it hadn't really affected us the way it's affecting us now. So taxes, insurance, and materials related to repairs have skyrocketed since that period of time.
Mm-hmm. Well, and interest rates went up. So there's a tug and pull between all these things, right? So if interest rates go into the 6s, right, or the 8s or whatever, and you can go get a bond at 4, 5, 6%, or a 2-year bond, for example, if you can go get one of those at 6% return, 6% yield. So like in the investing world, cash on cash is related very directly to yield, right?
Yeah.
It's what you get back out of it. Well, a bond, if I have even a 7% bond, right, or even a 6% bond, if I'm looking at a real estate investment deal and I can earn 8% cash on cash, and I'm looking at bond prices and it's 6% for 2 years, well, that 6% is guaranteed and it's almost no risk. Right? There's almost no risk of not getting that 6% or default or any of that stuff, depending on what the bond is. But I'm talking about like a treasury bond that's tied directly to these interest rates.
Right.
Well, that 2% may not be worth the risk, right?
Mm-hmm.
That's where we were at that time. So you needed to be able to give 12%, for example. Well, it was also on the real estate deal side, it was easier to obtain 12% while interest rates were it was harder to obtain that. So these things, they ebb and they flow, where 6 to 8% right now would be considered good. 6 to 8% 4 years ago would not have been considered good. So, and I'm not just saying this. This is what we were seeing. This is what investors were putting out there on deals. So when the returns start to go down, it does help secondary market prices go down as well.
Hey, can we simplify also what we're talking about when we talk about cash on cash? So like in a really simple form, like the cash that you actually have into a deal, right? And you can look at it, and it's actually two different numbers. So let's clarify which one we're talking about, because you can look at it as including your initial capital, right? You just purchased the home. Maybe there's a down payment, some closing costs. Maybe there's an initial renovation done. That's what we call initial capital expenditures. So you could include that in that number, for looking at that investment as a whole, or you could just say, okay, business is set up now. Let's call it a business, and now what cash I'm spending to operate this business, and what's the return, and that's kind of a different number, right? And I bring this up for a reason, because what I hear is like we'll do a turnover, and people will be like, well, shoot, I've got $8,000 turning this over, and I don't want to have to do this for another tenant. I don't have to spend another $8,000 on the next time a tenant leaves. Well, they don't, and they're not doing the calculation of over the past 8 years that they've owned the home, right? And how much, if you add that 8,000 to the total amount that they've ever spent, what is your actual cash on cash return, which is what we're kind of talking about, right?
Kind of. I try not to use cash on cash is used less in continual operations because it's like, what time horizon are you looking at? But yeah, I mean, you're not wrong. You could still you can go all the way back to the initial acquisition, bring it back to where you are today. For the first 5 years, you brought in, 20 grand in net income every year, and then now you're spending 5 years later, and that blows it all up in your head. Well, you just took 8 out of a pool of, money. But cash on cash is usually used as an analysis tool to expect what you will keep in your pocket,
Right.
hopefully not have to reissue. But that's where reserves and all those things can come into play when you're doing an investment analysis. So how much of the cash you get returned gets put into a reserve, and then I'll save the internal rate of return conversation for another podcast because that will really muddy the waters. But what's the yield? If I can go get some mutual bonds at one price or stocks at one price or mutual funds is what it's meant to say, and then bonds. How do you weigh all those metrics? So the other one right now, real estate has actually better yield than some of those products as well. So and that varies with the markets.
Yeah, no, it varies with both the real estate market and the bond and stock market, right? Like, so all of it. And
Well,
right
what are
now,
mortgage rates based on?
well, they're based on securities, but
Long-term treasury
right,
rates.
but like right now, I mean, things are even affected by things you wouldn't even think about, right? Like oil, right? So now all of a sudden, oil is a factor that's going into all of this, and it's going to start. By cutting into everyone's...
We're back in the materials. Prices of materials are going up.
Exactly.
Going up. So, and does that affect renovations? Does that affect, budget projections? It all affects it. And depending on the type of industry or like commercial real estate is where that's where cash on cash is used the most amount of time, right? Well, commercial real estate also gets priced based on operational success, operational cash flow, all these things. So, the expectation in the market for a return. So if the market is expecting a 6% return now based on market conditions versus a 10% return, that directly affects the value of your real estate. So that's literally the metric for pricing commercial real estate. So
yes.
you could change nothing and hold on to commercial real estate until the expected returns go up, and now the value of your commercial real estate goes up. So the market plays a big factor in it. It's such a simple number that can apply a lot of places, but is really a valuation metric as well. Because on a high level, what the yield you get is where the value comes from. So.
Yep. Yes, sir.
Because if you're going to buy a $2 million property in cash, right, you hope you get some cash on that cash, right?
Well, and most people leverage that as much as they can, so they can buy more properties and do other things with that. So that's the whole, again, going back to the power of money, right? And also affects your cash on cash investment, your expected return, right? So like if I put in on that $2 million house, if I put 200 grand in, then my return is going to be based on that 200 grand, right? If I buy it cash, then my return's based on that 2 million. It might work out great either way, but the point is I can take that $2 million and spread it out over, and buy 5 $2 million houses instead.
Yeah, I mean, that's another analysis tool of how acquisitions are done. Some people would be like, just in a simple mindset, they'd be like, well, if you have the cash, why would you even get a loan on this deal? Well, you can do the math sometimes, a lot of times, and find out that if I put 20% down and I pay, say 6% interest or whatever it is on a loan, And what does that cost me per year? What does everything come out to? Well, if the 20% down is if it's 200,000, I put $200,000 cash in. If the full price is $1 million, then you put $1 million in, right? Well, what cash does that earn per year? Even with the interest, even with all those things coming in, sometimes you earn more based on the money you put in with the financing.
Well, especially if you do something else with the rest of the money, right? Like if you have $1 million and you only spend 200,000 of it on that $1 million property, then do something with the other 800,000, right? Like go buy more properties or stick it in the stock market or whatever you're going to do so that it can make you some money. If it's just going to sit in a savings account, then yeah, maybe you should have just dumped it into the property.
And even if it's the same, I've seen if you take 20% and you buy 5. And the cash on cash with financing and without financing is pretty much the same. Say they land at 8%. Well, the appreciation level of those real estate assets is likely similar too. Well, if 5 assets appreciate at 3%, you will earn more in appreciation than 1 asset appreciating at 3%. That's just a math game. So where does that offset? And that's your starting point, is just using what's your yield. So. And it's really high level. We're speaking about it very simply because it brings it back to yields. It's the best way to compare it to other investments. So I know we did one on that, but whether it ebbs and flows with the market, it actually has a huge impact on the market. It's not just the actual cash on cash return that you're getting. It's the metric of what the market is expecting. Yeah. So like right now they're expecting like, it's 8's good. I've written up deals where 8's good, and I've written up deals where 8 was bad, and that's all just dependent on what the market is expecting.
Yeah, and I would just encourage everyone to once again, don't be short-sighted. Don't focus on these metrics as much. Do this for the bigger reason, right? Do it for the long haul, and make a legacy business from your real estate portfolio, and don't. I would encourage people not to. You want to know what these numbers are, and you don't want to have your head in the sand. And you want to get rid of investments maybe that are bad investments, and maybe sometimes flip them out for better investments. Nothing wrong with that. But I just see people over-infatuate about these numbers instead of just sitting tight, letting cycles run through, and don't forget that this is a long-term play.
Yeah, it's the fear of... It's like FOMO, right? The fear of missing out. It's like, well, this property is going down and the cash on cash is getting bad. And like when things are at its worst is generally just not the time to sell. Or it's generally not the time to exit, right? This applies the fear and greed index, right? That is market wide. There's market specific ones, but good old Warren Buffett's when people are fearful, be greedy. When people are greedy, be fearful. It's time to be greedy because there's a lot of fear out there. There's blood in the water.
I'm thinking about so many past podcasts as we talk. We've done one on capitalization rate, which is a similar conversation. We've done one on realizing your gains and your losses, which is, kind of what we're talking about right now is, once you do that, you realize whatever your gain or loss is at that point, you realize it right then and there, and it's no longer there. I go back to, here's another one that we did back earlier in the early days. I go back to that concept of creating a tree of wealth, right? And that's what this is. This is just some branches and leaves within that tree of wealth, right? And the more trees that you plant, the more wealth you're growing, and the better your future will be, right? For both you and your family and your ancestors and everybody down the line. So
it's got to beat inflation too, because you mentioned inflation before, but is inflation 3% expected? Well, then you need to return more cash than the rate of inflation, because it's not a good metric to make this comparison, but what's your money earning if it's just sitting in a bank account?
Right.
It's being devalued by a lot of things. You can call it inflation. You can call it money printing. You can call it the combination of doing all of it. But it in fact does devalue your dollar, which you don't have to tell anybody. You don't have to keep telling everybody that. They're probably feeling it these days. Everything that was said was this would have an effect on the prices of things. It has, right?
Absolutely.
And it probably will continue to. So
I think we're going to see it hit us, at least temporarily, here in a minute.
There's only two sides to inflation. There's winners and losers, right? You have asset holders win, non-asset holders lose.
I was thinking about this yesterday while everyone's freaking out about the price of a boil. Oh my gosh, can't speak. The price of a barrel of oil. Thinking to myself, well, I bet you the people who have a bunch of oil to sell right now, I bet you they're not complaining at all.
Well, I bet they might be, because it's a sticky line.
They're not complaining. They are.
They like the money when it booms.
They are
right?
selling at the high point as much as they can.
Yeah.
Especially if they keep the Strait of Hormuz closed up, then they'll be like, okay, they need more of my oil. Let's go. Let's go.
I don't want to talk global economy on oil. That was everything is affected
That's
by oil. The price of everything.
I'm sorry. I got us back away from cash on cash.
No, you're good. You're good. If the guy getting the wood to the carpenter has to pay more, and then the carpenter's got to pay more, and then the guy driving your property's got to pay more, the costs go up. It's just the facts of life. So we can just make oil free on this podcast and call it a day, right?
That's right.
How many barrels you got in reserves?
There's a cash on cash evaluation you'd probably like to do right there, right?
You want to be landmen?
No.
You want to go?
Nope. I don't. That's gambling at its finest right there.
At its finest. So yeah, if you, I don't know, you want to get.
I think
more
we're done. I
cash
think
on
we
cash?
killed
We could go
cash
get some
on cash. Pretty
Put
soon
it
we're
on some cash.
gonna have to figure out what the acronym is, and I do not want to start.
I've done the
there.
visual example for someone before. Didn't understand cash on cash. I'm like, all right, well, if we take this cash that you put in, and now I come from this deal and put cash on top of it. That's how much cash you have on your cash.
Okay. Let's bring it all the way back to all of us. All of us have a first example in life of cash on cash. And that is usually our parents took money that we got from birthday gifts or something like that, put it into a savings account for us and put our name on this savings account, right? My parents did that. I know we did that for y'all. And so you have an account now. It's your first bank account, and you get to see not just the money that you put in being saved, but you get to see the interest that it's bearing, right? And it's a small amount at those amounts, but it's still your first example of cash on cash, right? You put $100 into this account, and I didn't do anything with that account, and I came back a year later and it's at $108. Well, I made $8 because it was just sitting there, right?
Yeah.
Now you multiply that by 10,000, and now we're talking about some
different
money.
Number.
Yeah.
It's like, where do you park your money while you're considering all these things? Like, is it sitting in a money market earning 3%, hopefully beating inflation at least at that point, or is it just sitting in a savings account earning 0.0001? Oh wait, I missed a 0. 0.00001. Depending on where it's at, but
is that where we're at right now?
What? Your bank, if you in a normal savings account, it's a money market. Yeah, they're at like 3 to 3.25 right now.
I'm doing CDs I think we're doing CDs
are a little
at like
different,
5 or 6.
Slightly different, but yeah, those are depending on their long-term dating and everything. Yep. So, if you want to put your cash on your cash, you need cash to do it. Right? That's essentially what it comes down to.
If you want to get cash from your cash, call us. We'll help you get cash from your cash.
So I'd love to help anybody who hears this, has more questions on it, analyze a deal or learn how to analyze a deal with it. If you want to do that, give us a call, 817-818-9039. Shoot us an email at showmethemoney@weartpm.com, and we are out.